Let's face it, retirement feels scary. There's something about the end of that steady paycheck coming in that feels really scary to most people from a financial as well as really a lifestyle and emotional perspective. In this video, I'm going to address some of the biggest financial concerns for retiring that I see over the next few years or maybe the next decade or so. These are the concerns that I address with my financial coaching clients who are looking to retire in the next few years. This channel is for proactive investors. It's about optimizing investment strategies. It's about strategies other than long-term buy and hold investing in stocks and bonds for decades, because historical data clearly shows us that this has worked brilliantly in some decades, but not others. And it's about income streams because, well, the more income streams we have as we head into retirement, or in retirement, the less retirement savings we need in order to fund those retirement withdrawals. And by the way, I'm Camille, an accredited financial counselor. The information I share here is based on my own education, research, and mostly firsthand experience over the past 40 years or so as an investor in all forms of assets: stocks, bonds, real estate, and small business now. You've heard me address some of these retirement risk concerns here before. I'm making this video because a lot of the information you see for retirement planning doesn't address the 40-year decline of interest rates until very recently, and the incredible bull market that the stock market has experienced in the recent decade. But we know this has got to affect what's going to happen over the next few years or decade. So let's talk about this in this video. Now, I want to say that I took a road trip by myself to Taos. It was about a 12-hour drive a couple of weeks ago. I wanted to squeeze in a few days of snow skiing, which I still love. And on the way, I listened to Ray Dalio's recent book, I've got it here, called The Changing World Order. And I found that this book validated a lot of my concerns about these risks that I've just mentioned. So I like to find and learn from people who are really way smarter than me, especially if they can spend millions on research and I can't. And I like to learn from them. So this is one such example. The key I've discovered, though, is knowing who to listen to, because some of my biggest mistakes have come from listening to the wrong experts. So I don't listen to many people anymore, but I do listen to Ray Dalio, and this book really reinforced and inspired the video that I'm going to make today here. And also it inspires much of my work because I like a really long-term perspective. And long-term is not 5 years. Long-term is really not 10 years. It's longer. So that's what we'll talk about in this video. Okay, so back to the risk of retiring. That was kind of long. Back to the risk of retiring in the next few years. There are always problems, and I know we can't live our lives in fear. I don't want you to think that that's the approach that I take. I don't. I grew up with the Watergate situation, bra burning, 20% interest rates. I grew up in a time of uncertainty, or at least some of my life was during really uncertain times, much like we have now. But the risk that I'm addressing in this video and the past decades of investing have also influenced how I invest and what I share. Now, people think the very first thing I want to mention is, as a risk that I see, is people think that what has happened recently will continue to happen. This is called recency bias. Most investment research covers 5 years, like I was just saying, maybe 10 years if we go meet with a financial advisor or we analyze a fund. We're doing pretty good to look at 10 years of data to use for our analysis. But economic cycles can run 40 to 50 years or much longer than that. So we're using data that's only really applies to what's been happening lately. And that's not necessarily going to play out in the next few years or decade or 2 decades. Investment returns vary during various stages of economic cycles, and most investors just don't consider this in retirement planning. And then investors are caught off guard when things happen that they haven't experienced in the last few years or even decade or 2. So that's my biggest concern, I think, that I see in retiring, or as far as risk over the next decade, for retiring over the next decade, is thinking that's what has happened lately is going to happen over the next decade. And it's not necessarily going to happen. There's a good chance it won't happen. All right, so the next risk is along those same lines, and that's inflation. So inflation makes it so that retirees need more money to support the exact same standard of living. It's kind of a bummer. This standard of living, they'll want to support the standard of living that they had when they entered into retirement. Now, I know a lot of retirement planning is about cutting expenses and doing without in retirement, but I just don't think that's very inspiring. And I don't know that a lot of people want to cut their expenses when they finally have time to do the things that they want to do, especially for someone who wants to retire in their 50s or even earlier. So the effect of inflation on retirement withdrawals is that those retirement withdrawals have to be increased every single year for inflation to maintain that standard of living, and that compounds annually. So just think about, if you don't even think about the compounding factor, but you just say, okay, average inflation is 3%, and if we say over 10 years, then that's 30%, and that's not even thinking about compounding. If we did that over 20 years, which most people are going to be in retirement 20 years, then we're talking about 60%. So that means that there's going to be a huge increase in the amount of money that you need to live your same standard of living. Now, I get that when you're in your maybe late 70s, 80s, you're going to scale back on a lot of the activities. Like, I probably won't be snow skiing then, for example. And you're probably the same, right? You're going to spend less money on certain things. But those earlier years of retirement, forget it. Who wants to scale back? And so inflation is problematic for maintaining that standard of living. And while we do have periods of stagflation and deflation, inflation is the most common. Now, I've done a video on a simple calculator that you can use, so make sure you look at that video. It will show you, if you take your standard of living now, how much it will be in 5 years, 10 years, 20 years, 30 years. And that's going to be super, super important for you in planning for retirement. So this is a big risk that I see, that a lot of people simply are not anticipating how much more they're going to need in retirement due to inflation. And let's don't forget, inflation was 13% in the early 1980s. Wow, that's huge. So that's a big one. So think about inflation in your retirement planning. The next inflation risk is that intervention from the Federal Reserve due to the financial crisis in 2007, and then more recently due to the economic shutdown, has significantly deteriorated the value of the US dollar. Now, I'm in the US, so most of my videos are geared toward US investors. Here's a very, very rudimentary way I like to think about this, because it's hard to conceive of that. It's complicated, right? The Federal Reserve actions and interventions are complicated, but here's a really, forgive me for how basic this is, but I like to think of a nice big chocolate cake that you're going to divide among 8 people. But then the chef decides to cook 10 more cakes for the same crowd to eat. And then all of a sudden you're sick of chocolate cake. The pieces are too big. They just have lost their value and their appeal. It's the same way with the dollar and the depreciation of the dollar from increasing it. So the United States, it has a limited certain amount of lending power that can go around, and that lending power just keeps getting diluted and stretched beyond capacity repeatedly, and that's happened so much over the past decade or two that it's likely to be really problematic going forward for retirees. All right, my next concern or risk going into retirement over the next few years is related to this, and that's that Federal Reserve intervention in the form of, for example, sending out checks during the shutdown, lowering interest rates until very recently, etc., has sustained the stock market during recent market downturns. It just makes sense. If investors get a lot of money in their hands and they put it into the stock market, which studies showed that happened a lot with the stimulus checks, that's going to drive the market up. Hello. So now, however, interest rates, they can't go much lower. They're still really low, even though they've come up a tiny bit. So they can't go much lower. And the government debt has grown so enormous from previous interventions, as I was mentioning earlier. So this will make it difficult for the Federal Reserve to provide future bailouts and economic stimulation when it's needed in the future. That's kind of a risk going forward. It is a risk going forward. Okay, next risk going forward is that retirement planning is usually based on making 4% retirement withdrawals to live in retirement. So you just withdraw 4% of your investment savings, and that's how you live, along with any other income streams that you have, things like Social Security, or if you have alternative income streams like rental properties. So one risk with planning on the 4% retirement withdrawal rule, though, is that the study period for which the safe retirement withdrawal rate was calculated or shown to be valid, it will be different from the time frame in which you actually retire, because it just will. While averages can be really useful for estimates, that's all we've got. I like to say we've got to go with estimates. That's all we can do. We have to know and realize going forward that actual returns for any one decade can end up being really different than the averages were that were used in creating the financial plan or the retirement plan. The economic situation that we're in now is quite different from the economic situation that we've been in for the past few decades. To mention one thing, the prime interest rate was over 20% in the early 1980s, for example, and it's steadily been declining since then. Declining interest rates have a stimulating influence on economic expansion. The economy can grow more because interest rates are low and businesses can borrow money and people can borrow money cheaply, and so that stimulates growth, and that stimulates the stock market. Lowering or declining interest rates also drive up the price of bonds, which has really helped investor portfolios. Stocks and bond portfolios have risen simply because we've been in a multi-decade interest rate decline. Yet a lot of investors are using the investment performance over those past few decades to create their financial or retirement plans going forward the next decade or two. But we got a different situation going on now that interest rates have gone so low. The next risk that concerns me with retirement is that asset prices, such as stocks, are inflated, home values are inflated, and what happens when we have assets that are inflated is our net worth gets inflated, and it may not be sustainable. The same can be said for the stock market as it can for our homes. So people can go into retirement with a retirement plan that's based on a net worth, because that's what we use, our assets minus our liabilities. That's kind of our net, it's our net worth, our assets going forward. And we use that to plan for retirement. We use our investment portfolios to plan for that 4% retirement withdrawal. But that's not necessarily sustainable going forward, simply because asset prices are so high now relative to historical valuations. So what can be done about this? Well, let me just touch on just really briefly a few things. I've got other videos where I talk about it, so be sure to check that out. But first of all, you can use long-term historical data for investment planning. Not 5 years, not 10 years, but you can look at 40 years going back at least in making your plans for retirement. You can say what's happening now and what might likely happen in the next decade or two during my retirement years. You can create your own little economy by planning for at least one income generating asset or activity during retirement. There is something that everyone can do based on their skills and their passion. I like to say that figure out what works for you and do that. For one person, it's investing in a different way. For another person, it may be some sort of business. Some of my favorites that I use and or have clients use are consulting income, real estate, rental property income, and selling covered calls. Although I do want to say basic covered call strategies are dependent on an increasing stock market. And then the next thing is just to consider investing in assets that will increase in value due to inflation as a way to protect your net worth as inflation increases over the years, or as inflation rises over the years and affects your finances. And then finally, consider investments besides stocks and bonds that do well during various times of the economic cycle, not just during the long periods of lowering interest rates, but think about what will work well moving forward when economic times are different. Finally, plan for the worst, but hope for the best always, always, always. And remember, retire certain with enough money to sustain your lifestyle for life.